Okay, here we are. It's 10 o'clock on Tuesday. It's time for our Tuesday weekly webinar. Good to see everybody. I hope you're having a great week so far. Today is Tuesday, November 14th. So we have some headlines to go over with you, some significant headlines today. I think I've got 3 in total. So we're going to spend a little bit of time talking about that. We're going to go over the markets, what happened in the markets last week, and then read an analyst report or two. And then we're going to talk about our Financial 15. And our Financial 15 today is tax loss harvesting. So last week I talked about year-end planning and things that you should be doing for or considering and looking at for the year-end. These critical items that you can't address after the close of the year that may be important to the effectiveness and efficiency to your financial plan and your retirement plan. So tax loss harvesting is one of those things. Once the year closes, you can't go back and redo it. So I thought it deserved its own time. So we're going to talk a bit about tax loss harvesting today. And if you haven't already, please, and you're watching us on YouTube, obviously, please hit the subscribe, like, and notification button. And we always appreciate that. So let's go into our first section, which is we're going to talk about headlines. So the big one this morning, of course, at 8:30, the Consumer Price Index report came out from the Bureau of Labor Statistics, and it showed that inflation for October was flat month to month. So it's the first time we've seen that, and I don't know how long, but my gosh, it feels like a long time. So core CPI hits a new low with that report, a 2-year low, with that report. So core consumer price index hits a 2-year low for that period of time. So that's good news. And we're seeing the effect of that in the markets right now. So we have a lot of green on the screen in the markets, and the future shot up right after that report. So that's good news. And maybe that'll give us a continued break from the Fed increasing rates, and we can get back to some kind of normal market cycles. But we do have other concerns that we have to take into account. But this is a good piece of information that inflation looks to be easing, at least for now. So that's our number one headline. What else is on there? So we talked about standard deduction, and we talked about the increase in income that fills in those marginal tax brackets. Again, the marginal tax brackets stay the same. It's the income amounts, the taxable income amounts that fill those in. This is an interesting. So this was an interesting headline on Friday that really didn't seem to get much attention. I don't know why. Maybe it's the response it got from Washington. But Moody's downgraded the debt of the U.S. government to negative from stable. And I'll just read this to you. Citing large fiscal deficits and a decline in debt affordability, a move that drew immediate criticism from the Biden administration. So this move follows a rating downgrade of the sovereign by another ratings agency, that's Fitch, this year, which came after months of political brinkmanship around the U.S. debt ceiling. Federal spending and political polarization have been a rising concern for investors, contributing to a sell-off that took U.S. government bond prices to their lowest levels in 16 years. It's hard to disagree with the rationale, with no reasonable expectation for fiscal consolidation anytime soon, said Christopher Hodge, chief economist for the U.S. at Natixis. Deficits will remain large, and as interest costs take up a larger share of the budget, the debt burden will continue to grow. We've been talking about that quite a bit. So as the debt grows, of course, we have to pay interest on this debt, and it continues to grow exorbitantly. There doesn't seem to be any appetite in Washington to make any kind of significant cuts. So that's one of the reasons we believe that taxes have to increase significantly in the future. And we're starting to see, it's going to be a slow process. Remember that those tax rate increases are going to be, I think, pretty aggressive when they begin happening, probably around 2030. But we're starting to kind of see the seeds of it happening now. So something like a rating agency downgrading U.S. government to negative from stable, that's significant. And the fact that it's just not on every radio station and news station, I just don't know. At least I haven't seen it, and I paid attention over the weekend to see how it was being reported. So 3 major headlines. Inflation was flat in October from the prior month. Core CPI hits a 2-year low. The increase in the income thresholds for the marginal tax rates. So we went over them in some detail. And the downgrade of the U.S. government from a stable to negative rating. Significant. So let's get into our slot updates. So I'm going to share my screen here. And we're going to look at first RMDs when your IRA investments are not liquid. We talk about this a lot in our programs, in our slot education programs, because not you folks, I don't see this much, but let me just see if there's any questions. Good morning, everybody. Keith, I haven't seen any calculations on the IRMA brackets yet, but I expect to see those come out at some point. And well, I guess you wouldn't be asking if you saw them, but no, I haven't seen any, but they will. They'll increase. Remember, IRMA is a 2-year look back, so they tend to be a little delayed. But Leighton says, I calculate 5.4% increase to those marginal rates compared to current. Yeah, that makes sense. I didn't do that calculation, but that sounds right. So we talked about, let's go back to these RMDs when your investments are not liquid. So this is something we talk about a lot during our slot training updates. And it comes up often because there's IRS rulings all the time about these people who buy hard assets, real estate, businesses, things like that in their IRA. They see something on TV or YouTube or TikTok or whatever about buying these more complex assets in your IRA and these hard assets in your IRA. And people get stuck for various reasons. So Sarah writes a bit about it. So I'm going to just read what Sarah wrote here. It's very, very good as always. You may have noticed grocery stores stocking up for Thanksgiving and festive lights and displays going up everywhere. Yes, it's the holiday season, but it is also the season to take required minimum distributions. One question we have been getting a lot this year involves RMDs when IRA investments are not liquid. If you have a traditional IRA or a SEP or a simple IRA and you are age 73 or older during 2023, you must take an RMD by December 31st, 2023. The clock is ticking and time is almost up. Many IRA custodians, in order to avoid last-minute mistakes and allow enough time for processing, have deadlines even sooner. We talk about that all the time. We've been talking about that with year-end planning. Now, let me just take a little aside while we're talking about this. I'm going to be sending an email to all of our clients just reminding you that, everybody knows that CPAs and tax preparers are very, very busy from shortly after the beginning of the year until the tax filing deadline in April. Well, this is our busy time. So from about, really it starts in September, but certainly October 1 through November and December, we are really just very, very focused and very busy on doing our year-end planning and calculating and taking care of Roth conversions for clients. So I tell you that because maybe if you send us an email question and you don't hear back from us as quickly as you usually do, it's because we're working through this busy period that we have. So this few months that we have at the end of the year, if you would just equate it to an accountant trying to get the taxes done, from the beginning of the year to the tax filing deadline. So I'm not making excuses. I just want to bring that light to your attention. Where was I? The clock is ticking. The time is almost up. Many IRA custodians, in order to avoid last-minute mistakes and allow enough time, I'm here, have deadlines even sooner. And the reason I mention that because we talk about that all the time, especially with Roth conversions. It's not a 12/31 deadline. Missing the RMD deadline is serious business because there is a 25% penalty on any RMD amount that is not taken. It can be 10% if you take care of it within 2 years, but the core penalty is 25%. No exceptions for illiquid assets. For most IRA investments, once the RMD calculation is done, processing the distribution is no big deal. A cash distribution or even a distribution of property can easily be done, but for some IRA investments, it's not so simple. Some IRA assets, such as certain annuity products, hard to sell investments in real estate, may be difficult or almost impossible to liquidate. Distributing the RMD in shares of the investment may also be complicated or not possible. Despite these issues, there is no exception for illiquid assets to the RMD requirement. These requirements apply to all IRAs, regardless of the type of investment. So what's a possible solution? What if your IRA is entirely illiquid? There are some possible solutions. One of them is aggregation. The RMD rules allow you to aggregate your RMDs from your IRAs, just your IRAs, and take the total amount from any one account. If you have one IRA that is illiquid, you could simply take the RMD from that account for that account from another IRA that is liquid. Remember, there are limits here. You cannot satisfy your RMD for your IRA from a workplace plan or a Roth IRA. Another possibility is to make a tax year IRA contribution if you're eligible to inject some cash into an IRA. The Secure Act makes this possible by allowing IRA contributions at any age. Remember, that was a change. But you would need to have earned income, and you would be limited to the annual IRA contribution allowed. That may not be enough to satisfy the RMD. Your options are limited, and the problem will not go away. Each year, an RMD must be taken. While it's possible to get an IRA waiver of the 25% penalty, that can only be done after the missed RMD is taken. These issues are why it's a good idea to plan ahead if your IRA is invested in alternative investments. As you approach your required beginning date, be sure to keep enough liquid assets in your IRAs to satisfy your RMDs. Why does Sarah write about this? Because, like I said, we see questions and IRS rulings about these things all the time. And it's important to get this information out there because there's always new solicitations about investing in real estate, investing in hard assets that you cannot liquidate and distribute from your IRA. The IRS forces you to do that distribution so they could so you have to pay the tax. And if you can't do that, it's just going to keep piling up. So here's the slot report mailbag, the 5-year rule in RMDs, today's slot report mailbag. And Sarah answers these again. So the question here is, in 2020 and 2021, when I was over 65 years old, I converted some of my IRA into a Roth IRA. Does the 5-year rule still apply to me, or can I now draw out all of the Roth IRA without any tax consequences? What say you? Can this person take out all of the Roth IRA without any tax consequences? I'm interested to hear what you say. I made the initial conversion in December of 2020. If the 5-year rule does apply, do I need to wait until December 2025 on it to draw on it, or can I draw it any time in 2025? And this person is Howard. It's a pretty simple question, I think, but this 5-year rule can be confusing. I understand, but Sarah answers it well. She says, Howard, this is an area where we get many questions. There are 2 5-year rules that apply to Roth IRA distributions. The first 5-year rule applies to converted funds. If you're under age 59 and a half and you take a distribution of converted funds within 5 years of the conversion, a 10% penalty will apply. The 5-year rule does not apply in your case because you're over 65. This is one area where logic makes sense. Applying logic to this IRS rule makes sense, because what this is really set up to avoid is someone taking a traditional IRA, and everybody knows you can't take money out of a traditional IRA under age 59 and a half without a 10% penalty, with allowing for certain exceptions. This is set up to avoid being able to convert that to a Roth IRA and then distributing those, paying that tax and then taking a distribution and avoiding that 10% penalty. So the IRS says, we see the issue here. So we're going to wrap a 10% penalty into any distributions that are not held for at least 5 years until you're age 59 and a half. So in Howard's case, the 5-year rule does not apply to him on these conversions because he's over age 65. However, there is a second 5-year rule that applies when there is a distribution of earnings. Let me bring this up because I'm not sure if you saw it. However, there is a second 5-year rule that applies when there is a distribution of earnings, and that does apply to you. I'm right here. If your first Roth conversion or contribution was for 2020, you must wait until January 1st, 2025 before you can access your earnings from your Roth IRA tax-free. Good point. And of course, if there were contributions, they would also, you could, if you're over 59 and a half, you could receive those contributions back. But what Sarah's talking about here and what Howard's talking about is drawing all of your Roth IRA, and that includes earnings, and you have to abide by the 5-year rule. Jerry writes, argument for withholding tax when paying from cash accounts. What I think you're saying is argument for withholding tax when paying from cash accounts on RMDs or Roth conversions. So I think, Jerry, what you're asking is does it make sense to withhold tax or withhold tax from a distribution or from the RMD, or pay the tax from the cash accounts? It's always mathematically better to pay tax from the cash accounts. The RMD, you can certainly withhold. So let's break that down. So the RMD, you can withhold that tax. It's fine. You can pay the tax via withholding, net out the after-tax contribution. That's not going to make much of a difference because it has to go back. It can't go into a tax-free, Roth. It could go into a cash value life insurance. It could go and just about anywhere. It just can't stay in the IRA, and you can't convert it to a Roth. Converting money from a traditional IRA to a Roth is a different story. It's better mathematically if you can pay the tax from cash holdings outside of an IRA or investment holdings outside of an IRA. But that doesn't mean that it still doesn't make sense. Is it better? Yes. But is it better to do a Roth conversion and withhold tax rather than do no Roth conversion? Probably something you want to look at, but yes, in most people's case, I believe it is. But it depends on the individual. But good question, Jerry. Thank you. Okay. So here's the next question. I know you can delay your first required minimum distribution until April 1st of the year after you turn age 73 if you convert your entire IRA into a Roth before that date. But after you turn age 73, do you still have to take your first RMD distribution, or is there no distribution required as the entire IRA is converted prior to April 1st of the following year? I love this question because this is not an uncommon question. It's kind of, can we game the system? Can we game the system by converting the entire thing before the end of the year, in the year I turn 73, and then therefore I have no RMD. I've converted the entire thing to a Roth. There are no RMDs to a Roth. It's all done. Does that work? Well, Tom, sorry. But Tom, if you convert in the year you reach age 73, you must take your RMD prior to the conversion. That's the rub, right? This is because you must take an RMD for that year, and the rules say that the RMD must be the first money distributed from the IRA. This is true even though the deadline for taking an RMD is April 1st of the following year. So good stuff from the Slack group as always. All right, moving on. We're going to talk just a little bit about the markets because there was a lot of headline information, and I wanted to review that, and I don't want to go over too much. But what does our analyst group say? This past week, we saw initial jobless claims. That fell by 3,000 claims to a lower than expected 217,000, but ticking higher than the 200,000 even seen a month ago. So more jobless claims. But less than expected. The labor market continues to show strength, which will likely keep the Fed tilted toward raising interest rates. After reaching 265,000 claims in June, the reading has trended lower, which indicated wages could continue to see upward pressure. So continue. A weak Treasury auction last week. We have never reported this before, but the 30-year bond market auction, they write, on Thursday was the primary market mover of the week as it came in much weaker than expected. So the analyst writes, the investing community has been increasingly focused on the amount of debt the federal government is issuing, and those concerns were highlighted again when the 30-year bond auction saw a weak demand. What does that mean? Not a lot of people, there's a lot of people, but not like normal, wanted to buy the 30-year bond. It appears increasingly likely that investors are going to attempt to force the government to at least slow its runaway spending, and that process will likely produce more volatility. The week ahead this week, we know we had Consumer Price Index today. Good report. Tomorrow we have retail sales, and on Thursday we have industrial production. Then they go on to write about the week last week. A relatively quiet week in terms of economic data resulted in stocks taking a breather from the recent run and finishing modestly higher for the week. There was some volatility in the week on a weaker than expected Treasury auction, as I talked about before, and some comments by the Fed Chair Powell that some took as slightly more hawkish. Hawkish simply means they're going to continue to raise rates, potentially. The Fed is likely done or close to done, but investors will continue to key on data that could influence the central bank's decisions. Additionally, the fiscal side of the equation will likely add to volatility as seen this week with a budget or continuing resolution needing to be passed by Friday to forestall a government shutdown. Seasonality remains positive, and while risks remain, markets are likely to continue to be biased higher in the near term. So they think that markets are going to continue to have some travel upwards in the near term. And the Dow was up just 0.65% for the week. Still positive, though, 3.52% for the year. The S&P 500 was up 1.31% for the week. Positive 15% for the year. I'm really interested to see how the weekend, this week ends. This week after the CPI data. Mid caps were down. The small caps were down. Mid-sized companies were down 1.56%. Small companies were down 3.15%. They're down 3.18% for the year. And the bond market was down slightly last week. The Bloomberg U.S. aggregate bond market, which is what you hear me say, where most investors hold probably most of their bonds, was down 0.29%, and still year-to-date, bonds are down about 0.82%. All right, let's go into our Financial 15. So I'm going to switch to my whiteboard here. Just preparing the whiteboard here. And we're going to talk about tax loss harvesting. Okay. Tax loss harvesting. So this again came about as we were doing our year-end planning here, and we're gathering information from clients. And one of the things we always look at is, do we have gains in capital gains in accounts, and can any of these be offset with losses, realized or unrealized losses? So as we go through this, I'm going to talk about some of the pros and cons, but there's some risks involved in that also. So you can say, okay, well, I've got, it's this kind of lemonade rule. I've got $60,000. I'm just using that as an example. $60,000 worth of unrealized losses in my these are not IRA accounts or Roth IRA accounts. These are taxable, what we call taxable accounts, and we call them taxable accounts because you get 1099s every year for interest, dividends, short-term gains, long-term gains, etc. So sitting in that taxable bucket, can we take losses on this and kind of make lemonade out of these lemons, and then we can use those losses either to offset immediate gains or do what we call carry forward those losses. And you can then buy the securities back. You've got to pay attention to some rules around that. We're going to talk about it, but that's the general idea behind tax loss harvesting. Well, here we go. We have these losses in these taxable accounts. Does it make sense to sell them for a period of time? Potentially buy them back after the rules say that we can, and still own them. But we've now realized this loss. We still own the security, and we can either book the loss for this year, offset gains with it, or carry them forward into following years. So let's talk some more in detail. So what is tax loss harvesting? And again, if you're just joining us for the Financial 15, what we've just talked about on the rest of the weekly webinar is some headlines. We talked about the CPI data for October that was released this morning. We talked about the increases in the income brackets for the marginal tax rates. We also talked about the downgrade of the United States by Moody's. I think it was Moody's downgraded to negative from stable. Then we went over some investment returns and analyst reports for the past week. And now we're in our Financial 15. So if you're just joining us for our Financial 15, this is when we talk about a financial planning strategy or an investment strategy in more detail. And if you're just joining us on YouTube, you can hit the subscribe, like, and notification button so that you make sure that you don't miss any of our upcoming videos. And if you'd like to receive this video via recording, you can request to be putting on our mailing list by reaching us at attleborowealth.com. I'm just going to put that up here, attleborowealth.com. And if you want to schedule time with us or with me or have any questions, you can reach us at questions@attleborowealth.com. Okay, so what is tax loss harvesting? Now, I want to point out this is from Investopedia. I'd like to share things with you that you can grab via Google. Tax loss harvesting is the timely selling of securities at a loss to offset the amount of capital gains tax owed from selling profitable assets. The strategy is commonly used to limit short-term capital gains, commonly taxed at a higher rate than long-term capital gains, to preserve the value of the investor's portfolio while reducing taxes. I will say that that is the best use of tax loss harvesting, but it's not the only use. So I'll share with you here that here we go. This is the orange tax chart from the Slack group, and you can grab that from our website. Go to outerboroughwealth.com, go to resources, and drop that down in the Slack corner. And you can download these charts. But we talked at the beginning of the webinar about the marginal tax rates, and when you cross over into these other tax rates, as your taxable income increases. But we're talking about capital gains rates, and these are completely different. And long-term, and by the way, long-term capital gains we're talking about here. So it can be, you can pay capital gains rate at 0, 15, or 20%. Remember, I know I did a video about this. You got to pay attention to 3.8% Medicare surcharge. But, these are the income thresholds for the capital gains rate. So they're long-term capital gains rates. Now, short-term capital gains rates, I'm back over here on the left, they get treated like ordinary income. So what the piece from the excerpt from Investopedia just said is most people use tax loss harvesting to offset short-term capital gains. And while that's probably the best use of the tax loss harvesting, a lot of people use it also to offset long-term capital gains because, your capital gains rate could come in anywhere. Say it's at 15%, and say your marginal tax rate is at 22%. Well, obviously, if you can use your realized losses to offset 22%, you're in better shape. But if you exhaust all that or don't have short-term gains to offset, there's nothing wrong with using it to offset 15%. So I hope that makes sense. We can talk about that a little bit more as we go. You have to pay attention to this wash sale rules. Of course, there are rules around these processes. You can't just buy a stock, quickly sell that stock quickly. And we're going to talk about the rules, what quickly means from the IRS. Buy it, quickly sell it, realize a loss, and quickly buy it again and own it and have this loss booked or use it for your benefit to reduce your taxes. The IRS says there's got to be some parameters around that. So the main thing to watch out for when tax loss harvesting, this is reported in U.S. News, is the IRS wash sale rule, publication 550. I think I have a link here. Yep, publication 550. So you can grab that and read that publication if you'd like. Publication 550 says that when you sell a security or substantially identical equivalent for a loss, you can't buy it back for 30 days, nor could you have bought it 30 days prior to the sale date. So if this is your sale date here, you've got a 30-day span on either side of that. So if you bought it within this window and if you sell it within this window, you don't get to have the tax loss. It goes away. And you've got to pay attention to substantially identical. There's some questions around exchange-traded funds and mutual funds and how that, particularly exchange-traded funds. It also is in effect throughout the entire portfolio. So just like the fellow, I think his name was Thomas, who had the question about, well, geez, if I convert my entire traditional IRA by the time in the year I turn 73, do I have still an RMD? The IRS is keen to most of these things. So you can't liquidate a position in a taxable account and rebuy it in your IRA inside of the wash sale rule and think that you're gaming the IRS. This wash sale rule is in effect throughout the entire portfolio, your entire ownings. And it also includes a spouse, a partner, or other entity that you have control of. So I'm not saying you have control of your spouse or partner, but I can't, for example, I'm always reluctant to name a stock. But let's say Attleboro Wealth Management was a publicly traded company, which it's not. And we had, a significant loss in September, which we didn't. But let's just say there's a significant loss in September in this position I hold called Attleboro Wealth Management. And I say, I'm going to sell this position and I'm going to realize that loss for tax purposes. But I don't want to wait 30 days to rebuy this position because I think there's risk in the issue increasing. So I say, you know what? I'm going to have my wife buy it in her account or buy it in her IRA, and then we still own it, kind of. And I get to realize this loss for tax purposes. Again, the IRS is keen on that. We don't want to. You can't do that. And that includes through an issuer's dividend reinvestment program. So a lot of these are set on automatic reinvestment. And you can buy direct with different companies and different funds. So be careful about that, because suddenly if you sell something, you're trying to avoid this getting caught in this wash sale rule. You've got to know the nuances. And one of those is the issuer's dividend reinvestment program. Spouse and partners accounts or other entities, and you've got to look throughout the entire portfolio. So those things, these are missed a lot. People think that they can just, again, they don't really think it through. There's a lot of information out there on the on the internet about these wash sale rules, and it seems pretty simple. Okay, I sell it, I don't repurchase it until the 31st day, but if I buy it again in another account during that time, it's a potential problem. So we've got to pay attention to those things. The benefit. So Vanguard had a really great benefit, or a really great piece here. Vanguard writes, tax loss harvesting, a portfolio and wealth planning perspective white paper reveals that from 2000 through 2019, tax loss harvesting helped many investors earn an average annual benefit of 0.95%, an equivalent of almost an extra 1% in portfolio return. That's not insignificant. In separate studies, this would span 92 years from 1926 to 2018. The Massachusetts Institute of Technology, MIT, found that tax loss harvesting provided some investors with an average benefit of 1.1%. So there is a benefit to looking at this tax loss harvesting, but don't forget, it's got to be done, not the wash sale window, but the sale of the issue that you want to sell to realize those losses has to be done by 12/31, December 31st. Now, what do I mean by unrealized and realized losses? Some people refer to these as paper losses. Well, I look at my account and they're not really losses; they're paper losses. Well, if you buy XYZ fund and at $100 a share and it's down, $10 a share, then that is a loss of that position. If it's in a taxable account, you could liquidate that. If you owned it for more than 30 days, you could liquidate it. Realize that loss, because what's happening is in your account, when you look at it and you bought it for $100 a share and now it's down to $90 a share, that's an unrealized loss. So you haven't realized that. To take advantage of the tax loss harvesting, you have to realize that loss, which means you have to sell it. So you sell it at $90 a share, you realize the loss of $10 a share. However many shares you have, that's going to equal the dollar amount. And then if you wait the 31 after the 30th day, 31st day, you can rebuy that XYZ position. I'm using XYZ as an example. So that's how you realize that to have that tax loss harvested. So what can you do with that? You can offset that loss against any other gain. If you sold something prior or you intend to sell something later, even if it's in the following year, you can use the loss you've realized to offset that gain. So let's just say the loss we were just talking about is $1,000. And let's say it's long-term capital gains. Well, if you have a gain long-term capital loss. If you have a gain of $1,000, that is a long-term capital gain, well, you can offset that. So you've sold a position, you've had a gain, and you pay. If the you follow the wash sale rules, then you have no tax due on that because you've offset this gain with this loss. Now, what if you only have $500 worth of gains? Well, then you can use $500 of the loss, and you can either carry the other $500 forward. I have a chart below here from Vanguard that might be a little easier, but you can carry this forward. Or if you have short-term, I'm going to keep it over here, short-term capital gains. And let's say you've got $500 worth of short-term capital gains, and you have no short-term losses, so zero. Well, then you can, and you've got $500 left over that you could not use for long-term capital gains, then it can go to short-term capital gains. It first has to go like short-term gains to short-term losses, and short-term and long-term gains to long-term losses, but then you can cross over and cancel each other out. But if you don't have that, say you don't have that, then you can carry this forward. So you can carry it forward to next year. Or you can use it to offset income, up to $3,000 a year. Offset ordinary income. So losses can be used in future years to offset gains, or you can use it to offset your ordinary income at $3,000 a year until it's completely depleted. So I hope that makes sense. So I like this chart here from Vanguard. So this kind of shows investment A, $30,000 realized capital loss. Investment B, $25,000 realized capital gain. You use I'm right here. You use $25,000 in losses to offset $25,000 in gains. That leaves $5,000 in losses left over. You use $3,000 of remaining $5,000 in losses to reduce ordinary income. Taxes saved are, in this example, are $1,050. That's $3,000 times 35% ordinary income tax rate. So this person has a high income tax rate. Use the remaining $2,000 to offset future gains. That's in future years, or it could be the same year. If you did this early in the year and you said, I only have $5,000 in gains to use this year, well, you can use them later in the year, or they can carry forward. And this is tracked on your tax return, the loss carry forwards. They can carry forward to offset future gains. Now, what happens if you don't have future gains? What if you don't have any gains that you realize? It might be gains in your portfolio assets that are still in your statements, but you haven't sold them, so you haven't realized them. Then this $2,000 could be used to offset ordinary income again up to $3,000. So you can use $2,000 of that to offset ordinary income on next year's, 2024's, in this case, tax return. And if this was, let's just say this was $20,000 that was left over, $20,000, you can continue to carry it forward until it's depleted, or until you have $20,000 worth of gains, or any portion of that to offset that. So you don't have to use it all in 1 year. You can carry it forward, use it for future realized gains. You can use it for future offset of income. And people don't realize that. I was having a conversation with somebody who lost money on an investment, a business investment, and they lost about $50,000. And they said, "Geez, this is never gonna. I'm never gonna have an opportunity to recoup that money." I said, "Well, at least claim $3,000 a year on your income tax. This is a loss, so you can use that to offset gains." So investment B here, I'm over here on the right, $25,000 realized capital gains. Capital gains owed are $0. Capital gains taxes saved $3,750, because again, you use that you part of that $30,000 to offset that gain. So we saved capital gains tax $3,750. That's $25,000 times 15% long-term capital gains rate. That is subject to your income rates. Your overall income rates trigger those tax rates. So it can be 0, 15, or 20%, and you can have that 3.8% surcharge over a certain amount of income. And the total estimated tax savings of $4,800. That's $3,750 on the capital gains, and $1,050 on the ordinary income. So I thought that was pretty good from Vanguard. So that is a really basic overview of tax loss harvesting. Like everything else in the tax code, it is complex. If you want to consider tax loss harvesting, you should have a conversation with someone about it. You should have your team in place. Remember, your team should consist of, your CFP, a good qualified CPA, and at least probably one attorney. And all these folks should be working together. And a good group are going to be having these conversations about tax loss harvesting, planning for your year-end taxes, planning for year-end Roth conversions, and gearing up for 2024. So that remember that team, they should all be working for you and all talking. So these are the conversations we have on a regular basis when we're talking about year-end planning, and that is one of them is tax loss harvesting, taking a look at gains that you might have embedded in your portfolios and losses that you may have embedded in your portfolios, and see how we can offset that. Now, one thing I didn't talk about is there's a big risk in this. So if you would have liquidated lots of positions in the beginning of October and you had to wait 30 days, and the rules are pretty tight about what is a substantially identical holding. So you liquidated things that you had at a loss, and then you had to wait 30 days. You missed a lot of market movement potentially in October. So that's a risk that you have, because you're kind of sitting on the sidelines. Yes, you can technically replace a holding that's in the S&P 500 with an S&P 500 ETF. That is not a recommendation. It's just an example, but you could potentially do that to have some representation of the markets. I'm using air quotes if you're just listening, but it still may not be the same as the growth you would have in an individual stock. So that there is a risk that is involved in this tax loss harvesting, and that is sitting on the sidelines. So you've got to determine if the tax savings is worth the risk to you. And it's impossible to time. So anybody tells you this is the month you should do it because this month is always down, that's not always the case. So take that into account. So that is tax loss harvesting, and that is our program for today. I hope you enjoyed it. I hope you got something out of it. And if you have questions, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. We're making some changes to our website. They should be coming soon. I know we just redid our website. We're just making it a little bit better for you. So go check out our website at attleborowealth.com and keep an eye on it. We're going to have some good changes. And we continue to work on the Attleboro U site. I'm really hoping that'll be done. I'm just going to put a date of June, because every time I put a projection there for a date, it's going to be done. Last one was August. Then I was told October. So we have a new web developer, and I'm hoping that he'll be able to get this done in the next couple months. But I'm going to say in June, we should have a lot of coursework for you. That'll be completely no cost for clients. There'll be some subscription levels for individuals who are not clients, but you'll have some coursework, videos you can go through, and training you can go through, so that you can really keep on top of things and see our weekly webinars and go through our financial 15s and all the other educational content we have. All right, folks, have a great week, and we will see you next week. Take care.